Investment banking is quite different from the traditional banking products and services we've covered to this point. It's non-deposit taking in nature and is focused on helping organizations grow in different ways, through access to debt and equity capital markets, and through mergers and acquisitions, a corporate finance activity. We provide an overview of the products and services within this area in this course. However, if you want to explore all of the different products in greater detail, we encourage you to check out the courses available in CFI's Capital Markets and Securities Analyst program. An investment bank's products and services are usually split into two main categories: capital markets and underwriting, and advisory and corporate finance. Under capital markets and underwriting, investment banks will split into two groups, one covering equity capital markets and another covering debt capital markets. Where the client is interested in issuing their own financing instruments, the sell side of the investment bank provides the underwriting processes required. Where the client is interested in purchasing these financial instruments, the buy side of the investment bank will provide these services. Another very important capital market service that investment banks provide to clients is research. Research is provided to both sell-side and buy-side clients. Under advisory and corporate finance, the main services relate to industry coverage groups, mergers and acquisitions deals, and restructuring deals. The most important function of an investment bank is its role in raising capital. The bank does this by supporting securities issuances as an underwriter and providing access to its network of investors. Let's first take a look at how the capital markets function. We begin with the company who wants to raise capital. The company contacts an investment bank to help it through the process. In this case, the bank is the sell side of the capital markets. The investment bank will then contact its network of fund managers to see who's interested in the transaction. Fund managers are considered the buy side. We'll be discussing this relationship in more detail later, as there are rules around the sharing of information that come into play where the fund managers may be within the same institution. These fund managers represent individual investors pooling their money for investments and institutional investors. Cash flows from the investors into the fund, which then uses the money to purchase securities of the company or issuer through the bank. Thus, the cash flows to the issuing company. The investors will then be paid either dividends or interest, depending on the instrument purchased. When it comes to underwriting and securities issuance, investment banks usually break up their operations into two segments: equity capital markets, or ECM, and debt capital markets, or DCM. In equity capital markets, ECM, banks provide underwriting services to support equity-related security issuances. There are several types of services the ECM group provides. Initial public offerings, or IPOs, are when a company issues its shares to the public for the first time. Follow-on issuances are equity issuances that happen after a company has already done an IPO and is looking to do a further public offering. Private placements are deals where a company offers a round of shares to specific investors, but not to the general public. In debt capital markets, or DCM, banks provide underwriting services to support debt issuances. The DCM group provides various services to their clients related to the issuance of fixed income securities, also known as debt securities or bonds. There are a variety of different types of bond issues that the DCM group will underwrite. Where the DCM group is working with an organization that has strong financial position and stability and is considered low risk, they can help underwrite investment-grade bond issuances. Leveraged finance related to high-yield bond issuances are for organizations that don't have as solid a financial position and are considered higher risk. Some other types of bonds that the DCM group are in charge of include government bonds, emerging market bonds, and municipal bonds. Once again, for an in-depth understanding of the ECM and DCM products and services, check out the courses found in our Capital Markets and Securities Analyst program. To help you understand what underwriting is, let's look at the different types. There are two types of underwriting: firm commitment underwriting and best efforts underwriting. In firm commitment underwriting, the bank commits to buying the entire security issuance at a specific price. In this case, the bank takes on all the risk of the security issuance being undersubscribed. If the issue is undersubscribed, the bank is obligated to purchase the remaining shares. This essentially guarantees that the company will receive a certain amount of capital from the security issuance. However, banks can include a market out clause, allowing them to escape the agreement if something affects the quality of the securities. Turning our attention now to best efforts, there are actually two main types of best efforts underwriting agreements. The first is the all or none agreement. In the all or none agreement, the entire issue must be subscribed and sold within a specified time period. If it's undersubscribed, the deal is canceled and the bank isn't paid. Alternatively, there are mini-max agreements. Mini-max agreements are similar to all or none agreements, except that instead of needing the entire issue to be subscribed, this agreement only requires a pre-specified minimum to be subscribed. If the deal can't meet this minimum, then it's canceled and the money is returned to investors. As you can see, underwriting provides a valuable service for organizations as it transfers the market risk related to the security issuance to the bank. Because of this benefit, companies pay a premium to the bank in the form of fees, which are usually a percentage of the capital being raised. For equity issues such as IPOs, the fee ranges from 4 to 7% of the issuance plus offering costs, which is typically a few million. For debt security issues, the fee range depends on the type of debt security being issued. For example, investment-grade and government or municipal bonds are usually issued at around 1 to 2% of proceeds. With high-yield or higher-risk bonds, those fees could go up to 5%. Like equity issues, there are also offering costs or issuing costs that are also charged. These are costs that relate to registration, accounting, and legal services. Let's dig into one of the capital markets products in a little more detail. An initial public offering, or IPO, is when a private company offers its shares to the public for the first time, as previously mentioned. This is also how stocks become listed on a stock exchange. The IPO is probably the underwriting activity that garners the most media interest, so we chose this product to show you more about how securities are issued. In terms of splitting between ECM and DCM, an IPO would fall under the ECM's group's duties. In an IPO, a private company, which is a company whose shares are closely held and not sold to the public, decides it wants to raise money by selling its shares publicly, and it will choose to do so on an exchange like the New York Stock Exchange, or the London Stock Exchange, or the Japan Exchange. Usually, private companies have a few shareholders that control all the shares. But once it goes public, it will issue new shares and offer it to all investors, including large institutional investors and individual investors like you and me. This act dilutes the proportion of ownership that the original private shareholders have. For that reason, let's look at the two main reasons why a company would want to undergo an IPO. The first reason is to raise capital. The second is as an exit strategy for the existing owners. If we start with raising capital, issuing new shares and selling them to the public is a significant source of income for the company that it can use to fund future projects. For example, in 2012, Facebook did an IPO offering 421,233,615 shares for $38 per share. In this offering, they raised $16 billion to finance their continued growth. The second reason for a company to undergo an IPO is more related to the owners. Imagine if you were one of the senior executives of Facebook at the time of this acquisition, and you own shares equal to 1% of the amount that was issued in the IPO. That comes to about 4.2 million shares in Facebook. Upon the IPO, your shares would then be worth $38 each, meaning that they're worth about $160 million. In this sense, IPOs are an exit strategy for the company's leaders. However, it is important to note that there are often lockup periods that prevent existing shareholders from selling their stock after the IPO for a certain amount of time, just to ensure that they don't dilute the value of the company. The underwriting process starts with conducting due diligence on the company to see if it is a good IPO candidate. The bank will look at various factors affecting the IPO, such as the company's financials, its health, sustainability, growth prospects, risks, competition, and the industry it's in. Then, if everything looks good, the bank will process and submit relevant filings, such as the Securities and Exchange Commission's Form S-1, which is the registration document for an IPO in the United States, or a Financial Conduct Authority approved prospectus, which is the registration document required in the UK. The next step in this process is pre-marketing and valuation. The investment bank will meet with large clients, such as institutional investors, to pitch the company and get feedback about the firm, the IPO, and the price they would pay for the company. Once this is done, the banks involved in the IPO can create a price range for the company's shares. Finally, the investment bank will work with the company's management to conduct a roadshow, where they pitch the company to potential investors and take orders on the firm's shares. These orders indicate how many shares they would buy and the price they would pay. This helps the bank set a final valuation for the company's shares before the IPO finally happens. Once this is done, the banks will allocate the shares to the investors who are interested and offer the rest to the public. As mentioned earlier, banks charge fees to underwrite issues. For an IPO, these fees range from between 4 to 7%. Therefore, underwriting IPOs is quite profitable for the bank. However, if the company is a very hot offering, such as our Facebook example, the fees could be lower as many banks are competing to work on it. In Facebook's case, the banks that worked on the deal were given a 1.1% fee split across all banks, which amounted to $176 million. IPOs help a company raise proceeds for growth or exit, as discussed. Why would the public want to own shares of these companies? Let's take a look at some famous IPOs and where they are now in market value. As we already mentioned, Facebook IPO'd with each share being worth $38 in 2012. On May 15, 2020, a Facebook share now trades at approximately $211. So any investor that bought one of the original shares in Facebook from the IPO have made a gain of $173, or 455%. But not all IPOs are successful. For example, Groupon first IPO'd at $20 per share in 2011. On May 15, 2020, Groupon was trading at $1.08, which is a complete bust compared to its initial valuation. Finally, let's look at one of the largest companies in the world, Apple. In 1980, Apple IPO'd at $22 per share, selling out almost immediately. On May 15, 2020, Apple was trading at $307 per share. Something to keep in mind is that the value of the share post-IPO does not impact the company's cash position. These shares are traded in the secondary market. The company's cash raise is from the IPO itself. If the company wants to raise more money, it would need to do a follow-on issuance by going back to the public market and offering more shares. The final type of capital market service we will discuss relates to research. Banks provide research reports on companies in the market. This is also known as equity research. The goal of these reports is to provide an analysis and purchasing recommendation regarding a company's shares. There are 5 main aspects to an equity research report. The first is industry research. Industry research focuses on looking at the trends and shifts in the industry using tools such as a pest analysis. Next is the management overview. Understanding a company's management can help an investor determine what direction the company will head and how stable they will be. Naturally, an equity research report will also have the historical and forecasted financials of the company. Banks prepare these forecasts using a variety of assumptions that are derived from the research they've done on the company, its industry, and its management team. Using these financials, investment banks calculate a valuation for the company and a valuation for its stock price, and they use this price to provide a recommendation on whether or not to purchase the stock. Usually, you will see the recommendation in the form of something like buy, hold, or sell. Historically, research acted differently from other investment banking products. It used to be bundled along with the other products, and thus it was perceived to be given to clients for free. These clients were typically institutional investors, such as large hedge funds. While it didn't earn the bank any money per se, it was a marketing device for the bank to earn their business in future deals. However, with recent regulations, research can no longer be bundled along with other products, and investment banks must charge clients for it. Regardless of how research is sold, you might notice that there might be a conflict of interest here, because an investment bank can also be working on deals for the company it's researching. To prevent this, banks have restrictions on communications so that no privileged or confidential information can leak between the research and investment banking departments. This information barrier is known in business as a Chinese wall. Before we look into advisory services and corporate finance, we need to first understand what industry coverage groups are. For all of the products and services provided by investment banks, they have specialty groups that will cover a specific sector and geography. These tend to be grouped as consumer-related, financial institutions, financial sponsors, healthcare, industrials, media and telecoms, real estate, gaming, leisure, and lodging, and technology. Having industry-focused teams ensures that the investment bank is providing the right products and services to its clients at the right level of expertise.